Hi, and welcome to this morning's early global view. It is currently 7:10 a.m. on Wednesday, January 27th, FOMC Statement Day, and we'll get back to a bit of that momentarily. But for now, what we need to know is the data has remained pretty weak overall, but that has been offset in good measure by what Mario Draghi had to say last week about the ECB becoming more accommodative because the data remains on the weak side. And that is back to a bad news is good news equities market for now. And what has all this meant to the markets? Well, quite simply, looking at the S&P 500 March future short-term charts, hourly on the left, 30-minute on the right, we saw all the bad news culminate in that gap lower last Wednesday that drove it down below the 1865 to 60 significant long-term level. If you want to see more on that significant long-term level, then I would say you should look back to last weekend's the overall global view from last weekend, where in the beginning of the equity section we do cover the monthly chart in the S&P, but it's a very important long-term channel support up from the major low back in 2009. Now, the fact that it whipped below it on Wednesday but ended up back up into it by Wednesday's close and only slightly below it, this was probably the anticipation of the news being so bad that the ECB was going to be more accommodative. Needless to say, this helped the energy market as well from significantly lower levels after the S&P had knocked out not just 1850, but lower supports at 1831 from the low last August and 1813 from the Ebola scare low to get near 1800. It was back up. Now, Thursday morning, even though it was lower for a little while, the Draghi message started to sink in, and it left a fresh upbreak from 1859. So that now reinforces, along with the gap up on Friday morning, from the close at 1861, that reinforces the low end of 1860 to 65, which we suspect will hold at any initial retest. We've already seen just a bit of that and how buoyant the market was after selling off on Monday into the near 1865 to 60, but it has stalled in the 1900s so far, and this morning it is off 8 at 1888. And what's interesting about that is the market tried to leave a little bit of a down break late on Monday, about 1884. And so if it should erode back below there, it would set up a bit of a failure again in the near term that could lead to this test, and any kind of still hawkish Fed psychology is going to probably lead to a test of that area as well. If it can get much above 1900, then you have your classical next resistances up at 1925 to 32, up at 1960 area, and again at the bigger failed levels up at 1975, 70 to 75, and in the low 2000s. And that pretty much does it for the short-term view of the S&P 500.